Hello, we're at SuperReturn Berlin 2013 and I'm chatting with John Hahn, Managing Director and responsible for international activities at Providence. Hello, John.
Good afternoon.
John, it's been said that as we move into 2013, private equity has been on a bit of a fitness campaign through the financial crisis and is coming out of it stronger and more soundly based than before. What are your thoughts on that?
Yeah, look, I think it's largely true. I think we all come out of the period 2009 to 2011 a bit chastened. I think we understand that we need to stick to our knitting and deliver the returns that our investors expect. And at the same time, I think relationships with LPs have become more frequent, more fruitful, closer, which is completely logical given how much of their money that we're managing. So I think coming out of it, the industry is healthier in many respects.
Now let's just talk for a moment about the past years, because you're quite a very specialised and unique firm. You're focused on growth, you're focused on some particular sectors. Tell us about where you invest and what experience you've had in the past recent years.
Well, as you know, we have focused since inception on telecommunications, media, and latterly we have quite a lot of money invested in education. We stick to our knitting, always have done. Some of our business sectors are fairly cyclical, and of course those didn't do very well during the downturn, but interestingly enough are coming back very, very strongly now. Other elements of the sector we invest in are more platform businesses like pay TV, broadband businesses, and those actually sailed right through the recession. Did well before, did well during, and continued to do well after. And to some degree, it's that portfolio diversification that you're looking for.
Now, John, you said these industries and sectors are coming back quite strongly. What do you see in terms of deal flow moving forwards in the industries you're active in?
Well, in fact, post-2009, which was really a desert period, of very few assets in the flow because people simply weren't selling unless they needed to. And it turns out because of bank behavior, not that many people had to. In other words, lenders were pretty helpful in getting people through their covenant problems. After that, 2010, we've had actually quite consistent, not spectacular, but quite consistent deal flow. And our pipeline from a rest of world perspective right now, from a potential equity commitment perspective, is in the multi-billions.
Right. Now, John, you're a global firm, obviously with a lot of activities in Europe and especially in the US. What's the geographic balance and mix of opportunities you're seeing at the moment?
That's a good question. The US for us is always a more vibrant market, and that's probably the case for most people, and continues to be the case. So going forward, we would expect to put 50% or more of our future funds in the US, which has been historically the case since we began to broaden out internationally. Europe has been less active but less active, and I expect that to continue to be the case. And then the Pacific Rim is actually increasingly important for us, and I'm including India in that part. So India and Hong Kong and Beijing, which is where we have our offices. And those will grow as a percentage of overall portfolio allocation.
Now, you are a growth firm, but we are from a macroeconomic sense, at least in a very low growth environment, obviously in the developed countries, but also in emerging Asia. Does that cause issues for you, or are you finding growth opportunities in the markets and segments that you're investing in?
It's a really good question. And the answer is part of the miracle to some degree, or the reason for being a private equity is you do manage to find these growth businesses even in down times. So we probably have 6 or 8 investments made in the post-crash period, which are all growing in the mid-teens EBITDA sort of growth rate, which is, I think, great. As you said, we're growth investors. We put capital to work to grow the companies, not to restructure them, but to grow them, and we are finding those opportunities. It's not easy, but that's our job.
So in a funny way, it almost makes growth a more attractive option in a low growth macroeconomic world.
Certainly that's what we would argue with our investors, that in a world where growth is very hard to come by, broadly speaking in the economy, our history shows that we do a pretty good job of finding growth investments in all markets, and they're even more valuable, as you suggest, in a kind of fairly unexciting GDP growth environment.
Now, John, in private equity in general over the past couple of years, there's been a lot of talk about it's not financial engineering anymore, it's operational improvements, and everybody's drinking that particular Kool-Aid. Have there been changes for your firm, or given that you're more of a growth investor, is it same old, you're doing today the things you've sort of always done, growing the top line and the bottom line?
I think it's a bit of both, in fact. I mean, we have always been very focused on portfolio management, as should be the case, given that we're sector investors. If we don't understand the sectors we're investing in very well, then we're probably not doing our job. So I think in that sense, it's not an enormous change for the typical Providence investment professional. Having said that, we do also have a small, but I think very powerful set of advisors like Peter Chernin, the former number 2 at News Corp, Dick Parsons, a former CEO of Time Warner, Tony Ball, former CEO of B-Sky-B, and worked with us in our Cabo Deutschland investment. So these people are also important.
John, thank you very much.
Thank you. It's a pleasure.
Thank you.